Hello. Okay, so here we are doing reading number 29. The readings number do keep on changing, but the topic here we are doing is sources of capital. Now, where does the company get the capital from? Basically, we are focusing on company which needs capital in the form of either debt or equity, correct? But where do the company generate capital? Because capital is something that you require on and off again and again. It's not one time that you need capital, you need regular resources of capital, right? So we'll focus on what are the sources of capital. Then we will consider what factors affect your choices. First, we'll understand all the sources. Then what are the factors which will affect your choices of debt or equity? Those considerations we will understand. And then finally, how does the company manage its liquidity? Managing of liquidity is more related to your financial statement analysis, which you've already done with liquidity ratios. So it is more of kind of that. So very easy topic. Let's start with sources of capital. So these are your overall sources of capital, what is visible on your screen, right? So to manage short-term financing, companies need short-term resources of capital, correct? Multinational companies have need not only for short-term, but they also need money for long-term as well. So they have need for both short-term investments and short-term borrowings. They continuously, have to manage their treasuries. So where they continuously get inflow of funds and outflow of funds. For example, large conglomerates like Reliance Industries in India or Amazon, globally, or Walmart, they have huge inflows and outflows coming on a daily basis because of their, retail and other businesses. So they kind of need to manage this money, short-term money, and invest in short-term instruments and earn maximum return with safety. That is what we call as liquidity management or money management, which is, in many companies, there's a department called treasury, which does this job. So it is the treasurer's role to evaluate borrowing strategy and cost of short-term borrowing. So that treasury department's job is to basically be available with resources to generate short-term money, short-term liquidity immediately when the company needs. Now, overall company relies on two sources, internal and external. Internal is where the company tries to generate money within the company, from within the company. So what are the internal sources? Which you would see here: after-tax operating cash flows, accounts payable, receivable, inventory, and marketable securities. So most of these internal sources are through the management of working capital, current asset, current liability. All these are part of your current asset, current liability. First of all, what is after-tax operating cash flow? It is cash flow after tax. Basically, it is operating cash flow, that is net income, plus non-cash, that is depreciation, correct? Minus dividend payments, because after the payment of dividend, whatever is the additional cash flow that you can use for projects. So net income means everyone is paid plus depreciation to make it cash flow and minus dividend payments. So after all the capital providers are paid, debt and equity both are paid, whatever cash flow remains, that is the cash flow we can reinvest in the project. So the after tax cash flow is an important measure. It is a measure of how much cash the firm is generating from its business operations. Remember, also in FSA, we learned that the most important cash flow, there are three types of cash flows: cash flow from operation, cash flow from financing, cash flow from investing, and the most important cash flow is CFO. So that CFO is the most important cash flow, and that is the source of company's consistent cash. Right? That is internal source of company's cash. Then comes accounts receivable. Accounts receivable basically means debtors. These are the guys from which you are expecting money to be received. Managing of accounts receivable begins with calculating the average days of receivables, which is also called as days of sales outstanding. Remember, the accounts, these are all related to what you've done in ratios. You want your accounts receivable to be collected faster. That means you want the receivables turnover to be higher, or days of sales outstanding to be low. Basically, it tells you how quickly you collect money from your receivables, right? Okay. Comparing this ratio with the firm's historical or with the industry will tell you whether the company's management of receivable is efficient or not. Same goes with payables. Accounts payable means how faster you pay to or slower you pay to the creditors. Whether to manage liquidity, you want to pay to your creditors not fast but late. So it is the amount due to your suppliers, right? They arise from trade credit, which is a spontaneous form of credit. So the credit that you get from your suppliers, that credit is very much useful to manage your sources of funds. So the more conducive credit terms that you get, the more your safer sources of capital are, so that you can use the suppliers credit and manage your liquidity. Okay. Now, first of all, to overall understand that how the company is managing its internal funds, we will calculate a ratio called cash conversion ratio, which we will see, or which we have already calculated in financial statements. Inventory, carrying too little inventory also has problem, because then you may lose out on sales, correct? When there is huge order, you may not have enough quantity. On the other hand, if you are holding too much of inventory, you have already blocked a lot of your working capital. So even that is not feasible, right? Therefore, inventory, although they are quick source of funds, you should not have too much or too little inventory. So inventory management, efficient inventory management is also very important. Remember, a lot of your money stuck in inventory is also an issue, because that will lead to lack of liquidity. Now, there is short-term marketable securities. These are short-term investments that companies do apart from keeping their money in bank deposits. So in bank deposits, you hardly earn any interest, especially if it's current account, you earn no interest. So companies prefer to park their money in short-term marketable securities. So they are the most liquid assets. These liquid investments generally have a maturity which is less than 1 year. In fact, in a couple of them have a maturity of few days, right? They're very safe because most of these money is invested in treasury and other securities, right? And they are the quickest source of funds. So let's say a company like Walmart, which receives millions of dollars of cash flow every day, okay, or Amazon, or in India we say DMart, they receive millions of dollars of cash flow every day, that they may park in 2 or 3 days in a treasury bond, so that they earn some safer interest instead of lying that money idle in a current account or a saving account, right? So that management is also done by the treasury, and that's how they earn huge returns. Instead of keeping that money idle, they earn huge returns, and it's in billions of dollars of transactions. So even that penny counts, right? So that is what marketable securities are. These are companies' internal sources of funds, right? So the efficient management of working capital is company's internal source of fund. External sources of funds are where the companies will look out for funds from outside. So the first is, of course, financial intermediaries, that is banks, right? So major external source of capital will be financial intermediaries, which is what we call as banks. And from the banks, you get line of credit. These lines of credit are uncommitted and committed. And the third famous is revolving credit. Uncommitted, committed, and revolving. What's the difference? The name itself has the meaning. Uncommitted means the bank here does not give you a guarantee that you will have funds. It is the weakest form of borrowing. It is unsecured, and the duration is less than 1 year. The duration is generally less than 1 year. Okay. This is not stable resource, because if the bank has committed that, you know what, when you need money, you can come to us. We will see at that time based on the situation, and we will give you the credit, right? Here, the interest is only the compensation for the bank. For example, credit card or uncommitted line of credit. But what is committed line of credit? This is a more secured form of a fund, right? And here the bank will first check out, through the verification process, that whether you are eligible for it. Once eligible, bank will give you an assured guarantee that, whenever you come for us for funds, we will provide you funds in case. So mostly unsecured effective for 364 days and prepayable without penalty. So there is no penalty if you pay earlier. Lender, that is banks, has a legal bind to provide capital, but for this commitment that I give you as a bank, I will charge you some extra fee. So here there is a fee. In India, in many part of the world, this committed line of credit is what we call as bank overdraft, correct? So bank overdraft is a commitment by the bank that whenever you need money, I'll give you, but for a fee. Clear? Apart from interest, they also charge you a fee. Clear? Right? That is committed line of credit. Now, the best form of credit, the strongest form of credit is revolving credit. Revolving credit is a continuous form of a credit. This is generally done by companies when they need money for more than 3 to 5 years or maybe higher. Here, the company, let's say, have received a credit from bank for 1 year. After 1 year, when the company needs money again, it gets rolled over for another year if the bank doesn't have any problem. So it is the strongest form of credit used for longer terms, backed by formal legal agreements. Again, there is an additional fee and your personal credit is very much similar to this. Here, I'll repeat, if after 1 year, if your credibility is good, it gets rolled over to another credit for 1 more year. So it keeps on getting rolled over. So you are continuously having access to funds. This is the best form of credit available, but of course it comes at a fee, and also your financial statements or financial performance should be better to have this facility. Okay. Finally, if you require loan for a longer duration, right, and you have some collateral to give to the bank, right, then we will go for secured loans. Secured loans are loans backed by collateral like inventory or fixed assets. So the collateral, the asset that you provide can be short-term or long-term. Banks have a blanket lien. Lien means when you give a security to the banks have a claim on it. So in case if you default, the priority of that fixed asset or any asset that you put as a security goes to the bank. So the bank can sell off that and raise its, the default money, that the money that has been default, the bank can raise that. So banks may have a blanket lien that is claimed to current and future assets if primary source is not enough to repay. So if, let's say, I have given an asset to the bank as a security, if my security isn't enough to repay the loan, then the banks can have a claim on other assets also. This type of loan is a recourse loan. In a recourse loan, if there is a default from my end, not only my property, but other assets may also, banks have a claim on it to recover its money. Correct? That is a secured loan. Then you have selling of receivables, which we call as factoring. Factoring is a very unique method through which, let's say, I am expected to receive $1 million fees from my clients after a year. What I'll do with that fees, I'll take that fees, I'll take that receipts, go to the bank and tell the bank, I'm receivable 1 million after 1 year from my customers. Why don't you provide me the capital based on that? So what banks will do, or what the factoring companies will do, they will collect on your behalf $1 million after a year, and right now they will fund you. Correct? So here the company assigns accounts receivables and gets the credit upfront by paying the discount charges. So I will have to pay some charges. For example, let's say they'll charge me $50,000 for $1 million capital now upfront. So I'll get $50,000 less, and immediately I'll get the rest of the amount, which I don't have to wait for 1 more year. And then the receivables will be collected by the bank. Now, again, they can be recourse or non-recourse. In recourse, the company is responsible if there is any default in terms of the receivables. In non-recourse, who is responsible? In non-recourse, the bank is responsible. The responsibility is with the factor, that is the bank, in case if there is a default. Of course, which one will have higher fees, the recourse or non-recourse? The non-recourse will have higher fees because that's where the bank also takes a credit risk in case if there is default. So banks take the credit risk, therefore the fees of non-recourse factoring will always be higher. Okay. These days, you also have web-based bank lenders. These are bank lenders which have no formal bank. They are available for you. You can go online and collect, your credit, right? They typically lend to medium or small size firms and charge fees apart from the interest. They also charge fees, right? For example, in US and Europe, there are these famous companies called Square, Revolut, N26. I don't know whether you've heard about it. In UAE, you have Mashrak, Neo, then you have Upstart, Neo Finance, etc. These are global companies which provide you credit through online. You don't have to visit a bank. You have to fill in your details, attach some documents, and you get easy credit. Most of the banks which are going digital, they have this one platform wherein they are now offering credit directly through website, quick credit. They don't need a lot of, they don't need your visitation or any other things. Credit is now very easily available through website. Those are
So,
also the resources. Yeah,
so is this a commercial credit or a retail credit?
both. So here, if you notice, medium to small size firms, in fact, many startups have come up into this sector wherein they are providing short-term credit. Personal credit is, anyways, there are many choices. Personal credit, for example, there are many banks offering, or not banks exactly, but startup companies offering you paycheck related credits. So before, let's say you have a salary of $20,000. So that $20,000 you get upfront, and it gets deducted from your account when you get the salary. So in US, where people need money before their month end, also they can get such credit. That is personal. But here we are talking the sources for company. So companies are also, mostly startup companies find it difficult to get debt, right? Startup companies won't get debt capital from the bank. So the digital banks these days, they provide startups with initial funding. They provide funding for, for filing patent also. They provide funding for, I've seen they providing funding for, not only funding, they also providing, along with funding, they also give some assistance in terms of documentation, legal process, registration. So there are many group of companies who do a lot of services for startups and also funding. In fact, this Revolut, which I have seen, N26 is very famous in Europe. Square, I think, is in famous in US, and Revolut is one where you can actually open up an account online through invitation. And what I had seen in that is that you can load any currency. So there's no currency conversion charges or anything.
Oh,
You can transact in, for example, let's say someone like me, who doesn't stay in one country. I stay wherever I get a CFA badge. So I may have to transact in multiple currencies. So I don't want to open different bank accounts with different currencies. So this bank like Revolut, it gives me an account where, let's say, I load my Indian rupee, and I can convert. If I'm going to Europe, I can convert that into Europe. If I'm going to UAE, I can convert that into dirham. I don't need the currency conversion regulation or charges. So there are various banks which offer this. Now, this what I'm talking is from the personal point of view, but
okay.
many of these banks also provide short-term funding. Uh, in Europe, there is pair finance, which provides credit, for recovery. For example, let's say you have your insurance recovery. So they provide credit for small objectives, because they have so much of user data. They provide credit for so many resources. So they make companies' job easier for providing short-term credits. And for that, companies don't have to go to the bank. They do the bank's job on behalf of the bank. They do this job. They provide you regular credits. Now these credits may be generally very short amount, not huge amount. If you need huge capital, of course, then you will have to go for the sources that we are going to see, capital market sources. Most of these sources that we discussed here, they are short-term funding sources. Short-term funding sources, well, less
Right.
than. But if you need money for long term, if you are a very established company, then the best source of capital is commercial paper. Commercial paper is where you issue securities for, around 1 year, correct? But they are issued by large corporations, because you know what, you're going out in the market and raising capital. That is only possible if people know your company. So large corporations who have better credit ratings, they generally can directly go, instead of going to the bank, they can directly go in the market and issue commercial paper, right? It has the lowest rate for short-term funds, but as I said, only established companies can do this, right? Because if a startup company goes for commercial paper, no one will invest in them. You can also issue public debt or private debt. Private debt is when you issue debt to some specific investor only. That is private debt. But if you issue debt for all, if you issue bonds general in the market, then it's a public debt. Companies do issue public debt or private debt where your private debt is very sold to only few investors or one or two investors. So that is not traded. It is illiquid. It is not actively traded. But public debt is listed. So you can buy, sell the bonds also. These are major sources for large credit-worthy companies. They can go with this. They can issue bonds on a regular basis. Common equity, we already know common equity can be issued. It can be also public markets or privately issued equities, right? Both are possible. Hybrid securities, which are part equity and debt, both, for example, or preferred and equity, convertible preferred shares or convertible bonds are hybrid securities. And finally, the last source that we understand here is others, which is leasing. Leasing is also one of the sources of capital. Why? Because the company doesn't block its capital, but it rather takes the asset on lease. So leasing is also considered one of the sources of capital. If not leasing, then you may have to block your huge capital behind that asset. Most of the multinational firms, whenever they go abroad and set up a company, most of the times they are always on lease. It looks like they are not on lease, they have bought the property, but no, many of them are on lease.
These are the airline companies, right?
Huh?
Generally, airline companies.
Not only airline, I'll tell you, all these multinational banks that you have, right? In Bandra Kurla complex or in Lower Parel and all of them are on lease. Name me any bank or any financial institute that you have, any multinational company that you have, they all are on lease. They have fancy interiors and all. For example, let's say you work at BNP, just go and check. It's not their office. It's all leased.
Right.
No multinational wants to block their capital. For them, capital management is a very important thing. If given a choice, they would not mind paying higher leases, but they will have they will not go for investing in the property. In fact, that's the reason why, if you notice, when they initially come, they are in the south of the city, right? Then when the rent is increasing, they move towards the suburb.
Right.
Then they move downwards towards more. For example, I'll tell you, most of the banks initially when they came up, they were in where exactly Cuff Parade and all those areas, right?
Correct.
Then gradually, what happened? Then they moved from Nariman Point, that fancy area, they moved towards BKC. Then from BKC, now they go to Kurla or they go to Goregaon. It doesn't matter to them. For them, it is rent. Wherever the rent is cheaper, they go there.
Right.
So they need infrastructure. Of course, they need basic facility like a good infrastructure that you have in BKC and all. But of course, they always keep on evaluating where the options are less. And why after pandemic, why many banks or many companies have told, oh, work from home? Not because of pandemic, but because they realize that this is saving cost.
Correct.
I know so many companies who had 4 and 5 floors of office. Now they have only 1 floor.
Yeah. In BNP also, they have moved to Thane at a WeWork location. So they are now in a WeWork building. So it's like a pay and just work over there.
Perfect. So that's, what, trust me, in pandemic, companies have realized they can save huge cost. And that's the reason why they make most of the people these days work from home, because now the infrastructure has built that people can manage work from home. So companies are going to save millions of dollars by not investing in property and not even leases now. So that all the companies have cut their costs. In fact, if you notice the financial statement, all the companies' profits are very high in the last 2 years. So
Right.
pandemic has actually been a boon to many companies who had huge capital costs. So companies would be more than happy to give you a fancy laptop than calling you back at office. This is what is
Correct.
going to happen. And this is you know what, now the hiring will also be more on that part, that is this guy or girl, compatible to work from home? Do you know technology? They'll ask you, now these days interviews will change. Do you know how to work on Zoom or how to work on Teams? That those sort of questions will come in the interview, because that saves company a lot of money.
Right.
Okay, so these are the sources of capital. Now quickly we'll understand what are the factors that affects the choices. Now there are two factors: the firm specific, which we call as internal factors, and the macroeconomic factors. Okay, firm specific factors are company size. Always remember that when the company is small, right, it will not get fund easily from outside. So they will have to generate internal funding compared to capital market resources, which is for large companies. Riskiness of your asset: if the company's business is quite volatile, it is better it should go for equity rather than debt. Debt is not easy to get if the business is very risky. If you have enough assets for collateral, then it is better to go for debt, because you can get money at low cost. Public or private debt, private equity, which one should I go? Generally small companies find it difficult to get public equity, so they may do a private placement. Large companies will go for public equity. Asset liability management is generally case with insurance and other companies who have assets and liabilities both. So if there is a mismatch in them, they may require short-term funding. Short-term funding is generally preferred for ALM mismanagement. Okay. Debt maturity structure: remember, higher the maturity, the more will be the risk for the investor. So based on the interest rate, you will select the choice of funding. If you need money for long term, and if the long term debt interest is too high, then it's better to go for equity. So according to the cost, you will select the source of capital. So based on the interest rates of the maturity, lower interest will be preferred, lower interest rate choice will be better. Currency risk: MNCs finance using multiple currency loans to match their exposure. So MNCs may borrow not only in one country but multiple country, so because they also have to manage the currency risks. Agency cost: you will hear about agency cost a lot of time in corporate issuers. What is agency cost? Agency cost is the cost of financial distress making funding difficult. So the more and more you have debt in your company's capital structure, the more the existing capital providers feel riskier. So at some point of time, even if you keep on raising more and more debt, even if it is cheaper, the equity and others will feel riskier, because their chances of getting money becomes less. So that is the cost of financial distress. Bankruptcy cost is the cost when the company goes bankrupt. It has to do some formalities, and there are financial restructuring costs which are unavoidable. Flotation costs are high. Flotation cost is the cost of raising capital. Generally, the flotation cost for debt is lower than equity. So if the company needs not enough capital, but the flotation cost is high, so then you may avoid that resource. So the higher the flotation cost, the lesser that resource you will use. So overall, if you check what are the resource, what are the means for which the company will decide which funding to choose, it is cost, lower cost, less risk, and more flexibility. So cost, risk, and flexibility are the factors that the firm will choose. These are the factors that the firm will consider while choosing a source of capital. Macroeconomic factors: these are outside factors. For example, taxation. Remember, taxation makes borrowing cheaper. Why? Because companies get tax benefit on interest. So when I pay interest, I may pay interest of $100, but I get a tax benefit from government. Let's say if the tax rate is 30%, so $100 minus 30%. So my actual outflow is only 70 because I reduce my tax liability by $30, right? So if the tax are higher, debt is more preferred. If there is high inflation, again, borrowing on debt, borrowing is better, especially at fixed rate, because the interest rates are increasing and you are not, your cost is not increasing, you have borrowed at fixed rate. If the government decides to have high fiscal deficit is, we discussed this in economic, fiscal deficit is where the government is spending more and the taxes are less. So government is giving you more subsidies, more benefits, and taking less taxes from you. That is fiscal deficit. So if government is giving me more facility, right, more subsidies and all, then I may go for debt also, because government may, in such cases, give me a lot of subsidies that will reduce my cost. So higher fiscal deficit may lead to more subsidies. So that is what will, wherever the subsidy is available. If the subsidy is available in equity, I'll raise equity. If it is mostly it is available in debt, I will raise debt. So many times, for example, export companies, they have a policy where if you are an exporter, you can borrow at very discount rates, 1% or 2%. So then it makes sense for me to go and borrow. So government policies, if they are conducive, then you take that source of fund. Monetary policy is expansion. Monetary policy deals with interest rates. So if the monetary policy is expansionary, the interest rates are low. If the interest rates are low, debt financing is better than equity. Okay, so these are the broader factors. Now, as a company, how will I evaluate the choices? I will evaluate the choices. Basically, I will see what my funding plan meets up. So the company's short-term funding plan should ensure that it meets the below objectives. You need to have sufficient credit to handle the immediate needs of your cash, paying the salaries, paying for raw material purchase, etc. That is the survival thing that you need. Plus, if there is a seasonal sales, huge sales during a season or peak, at that time you need some extra capital to invest. So that you need to have sufficient cash to handle the peak or the season, and ensuring rates obtained are cost effective. So what you should ensure that even if the funding choice is available, you should ensure that its cost is lowest, right? You are not paying more than the market. That is what you have to consider while picking up a choice. So overall, if you notice, what is the biggest concern that the company should have with respect to what funding should I go for? Cost is the biggest factor, right? But apart from cost, there are other factors also that companies should consider while going for a funding choice. That is size and credit worthiness. As I've already discussed, large and credible companies, they have more choices. They can go for multiple methods to raise capital. Legal and regulatory considerations, less restrictions means more choices. So less restrictions are lower risk and makes funding easy. Sufficient access. So if your country has multiple banks and multiple startup companies, financial institutions, that makes credit easy. Flexibility or borrowing options, active maturity management will not lead to high exposure to a particular day where huge amount may mature. So you need to have a robust team who knows when are there going to be huge outflows, and accordingly they manage it. So you are not going to rush for last moment funds. So apart from all these resources, you need also to have a team which will help you with management of your capital. Now, one question that I'm very much expecting in exam to be asked is the liquidity management. What is liquidity? Liquidity management, first of all, liquidity from the company's point of view is your ability to meet short-term obligations, immediate obligations like creditors payment or buying of current assets, raw materials. That is liquidity. So liquidity is basically when you can transfer the cash easily, transfer any asset to cash easily. So it is your ability to meet short-term obligation using assets that can be transformed to cash immediately, right? The management of liquidity refers to your ability to generate cash when and where it is needed. That is called efficient liquidity management. So if you are able to generate capital whenever it is needed easily and quickly, that is sufficient, that is efficient liquidity management. There are two sources of liquidity, primary and secondary. Remember, when the company is doing good, you go for primary sources. Primary sources are company's own cash balances. These are the first point of contact if you need funds. If your cash balance isn't sufficient, then you go for short-term funding resources, which we just talked about: trade credit, committed, non-committed line of credit, bank overdraft. Those are the short-term funding choices. And if your cash flow management is effective, what is cash flow management? Collecting from the receivables faster, paying to the creditors late. That is cash conversion cycle. If your cash flow management is efficient, selling the inventory faster, then you will have enough capital when needed. These are company's primary source of capital or primary sources of liquidity when there is need of funds. This is what the company uses in a day-to-day operation. But when the primary sources are unviable, if the company doesn't have enough capital, if the primary sources get exhausted, you're not generating enough cash during pandemic, you are not generating enough revenue, short-term funding resources have stopped, then you will have to unfortunately go for secondary sources. But resorting to secondary sources can change the company's financial structure and operations significantly. They may be an indicator. When the company goes for secondary funding choices, it's an indicator that your financial position is going bad, it is deteriorating. They include going to the bank and negotiating for your debt structure, telling the bank, hey, I'm not able to pay the debt. Can we renegotiate? Can you extend the credit terms? Can you extend the duration? Can you lower down the interest? That is renegotiation, which is also called as refinancing, etc. Or you may have to liquidate your short-term or long-term assets, ST and LT, short-term or long-term assets. Maybe you have to liquidate your inventory or your property. That is what is liquidating. These are, remember, last resorts. And even if this is not sufficient, you may have to file for bankruptcy. So bankruptcy protection and reorganization is something that you may have to go ahead as a last resort. Okay. Now here, the factors that affect the liquidity position, which I have seen CFA Institute asking very much in exam, is what leads you to a position where the company goes into a financial stress. What are the reasons that you go towards the secondary resources? Then this is very important, and as I said, I've seen this coming in exam a couple of times. So the company's liquidity position improves if it can get cash flow quickly. But there are factors that weaken a company's liquidity position. What are the factors that leads you that your position goes down and you have to go for secondary resources like negotiating or liquidating assets? Two factors: drags on liquidity, pulls on liquidity. Drags on liquidity means drag means, what is the problem of drag? You getting money late. So delay or reduce cash inflow. So you're supposed to get cash inflow faster, now you're getting late. That is called drags on liquidity. Well, if your customers are not paying you faster, right, your money is blocked for long. This increase of your duration of money that is expected to receive, or increase of borrowing costs, that is called drags on liquidity. Example: uncollected receivables and bad debts, obsolete inventory which has become useless, and tight short-term credit due to economic condition. That is drags on liquidity. It makes getting money faster difficult. It makes inflow difficult. Pulls on liquidity, where you have to accelerate cash outflow. So drags on liquidity is with inflow. Drags on liquidity is related to cash inflow, and pull on liquidity is related to cash outflow. So you may have to pay the cash faster. For example, your vendor is demanding, please pay me faster, I can't wait. You'll have to suddenly arrange for a lot of capital. So this Examples include paying vendors sooner than is optimal and changes in credit terms that require repayment of outstanding balances. So what are the two liquidity related issues that we can have during the company? Drags on liquidity means your inflow of money has become late. Pulls on liquidity means the outflow of money has become faster. Both will put a stress on the company's liquidity management. Correct? Finally, to calculate the liquidity, whether the liquidity is enough or not, we have liquidity ratios, which we have already covered in FSA. So I'll quickly go through those ratios. Current, quick, and quick ratios. The common thing with both is that the denominator has current liability. In the numerator, you have current asset for current ratio, and quick asset, you have quick asset, which excludes inventory and prepaid expenses. Remember, both the ratio, higher the ratio, better it is. Receivables turnover tells you how faster you will collect from your customers. Inventory turnover will tell you how faster you sell inventory, and payables turnover tells you how faster you pay to the creditors. You inverse the receivables turnover ratio, it gives you days of sales outstanding, number of days it takes you for you to sell your, to collect money from your receivables. All right, I need this number, days of sales outstanding, to be low. So I get to know how faster I get the money. Inventory turnover, if I inverse the ratio, multiply with 365, I get to know days of inventory in hand. It gives me the number that for how long it takes me for me to sell the inventory. And payables turnover, when I reverse it, when I inverse it into 365, I get the number of days it takes me to pay. Right? So what is desirable? The most important thing is this: days of inventory and days of sales outstanding. For example, let's say it takes me 30 days to sell the inventory and another 40 days to get the money from the customers. So overall, it takes me 70 days to sell the inventory and then collect the money. This is called my operating cycle. Do I want the operating cycle to be high or low? Right? Do I want it to be high or low? Well, I want it to be very low. Why is that so? Because what does it denote? It denotes the number of days it takes for your raw material to be sold and converted into cash. Okay. So that is my operating cycle. Operating cycle should be low. One thing if I want to adjust in the operating cycle to make it a cash conversion cycle or net operating cycle is when I subtract days of payables. So let's say my days of inventory was 30 days plus days of receivables was 40 days, but days of payables were 20 days. So I take 20 days to pay. So when you subtract this, now it is 50 days. So 50 days is the total length of time it takes for you to do three things: turn the firm's cash investment in inventory. So you have the inventory, you sell it, you collect it from the customer by selling it, and also the time it takes for you to pay, right? So cash conversion cycle represents period of time that it requires financing. This is a very, very important indicator. Again, remember, cash conversion cycle should be low because that tells you for how long your money is blocked. So the lower the cash conversion cycle, the better it is. How can the cash conversion cycle be lower? Remember, if the days of inventory is less, if the days of sales outstanding is less, but if the days of payable is high. So if you realize here, what it is exactly telling me, it is telling me that if you want to make your liquidity better, don't pay your creditors faster. Don't pay your creditors faster. High cash conversion cycles are considered undesirable. So you want this to be lower, 50, 40, 30 days, not more. Okay. Shorter the cycles, the greater the cash generating ability of the firm. So the quicker you do, the better it is. You know, most of the e-commerce companies, how long do they take to sell the inventory and generate cash? Well, they don't have the inventory. They don't store the inventory. The inventory is with the vendors, isn't it?
Right.
So like Amazon is not going to hold the inventory. Amazon is not going to do. So Amazon's days of inventory is very less. Its days of collection is very fast because customers pay either cash on delivery or through credit card. So its days of collection is still very fast. So let's say Amazon takes inventory for 5 days, or let's say 2 days, and it takes another 2 days to collect the money from the customer. So 4 days. But do you know it pays to its vendors after 2 weeks? So it doesn't pay faster. It pays, in fact, late. So that way, Amazon's cash conversion cycle is very low, in fact, negative. That means Amazon doesn't need cash. It has already enough cash. Most of the e-commerce companies run in this system where they don't need cash. They have enough cash coming from customers and they don't pay the creditors faster. They delay that payment. So the capital is what they are always funded with capital. They know they don't need more capital. This is the business model why e-commerce companies want to reach to that point. And that's why they do cash burning. They spend a lot of cash in discounts initially, because once the cash starts coming like Amazon or Walmart, then you don't need funds. This is how they manage the liquidity. Okay. Well, that's it from this topic of sources of capital, right? Any question, anything? Any
Nothing, but just one thing. I mean,
yes.
maybe this would not be related to this topic.
Uh,
So project financing will be a part of this, or it would be some other thing, because this is another way of raising of debt, right? The company does. So
mhm.
will this
Like project financing means about.
like for example, like let's say a company who is into who wants to start a business of a renewable sources, right?
Right.
And
Okay.
it's a capital, and this is a long term project, right? So
Mhm.
in that terms, the company needs a huge amount of finance, which
Mhm.
it cannot go with a short term, but it needs the long
Correct.
term finance, right?
Correct.
So it needs some banks to get into involved, raise your
Right.
debt. So
Right.
now that type of finance would be part of this structure, or it would be some other thing.
So if see, first of all, in this case, because the money is needed for long term, so then you will have to go for capital market resources. So you will have to figure out if you need, let's say, money for 10 years, the project is for 10 years, then the internal and financial intermediary sources will not be sufficient. You'll have to go for long-term sources, like you'll have to issue debt or equity. That is the source. So then in such a case, you'll have to go with primary market issuance of debt or capital. That is the only source, because then you can't rely on the short-term sources. The short-term sources help you to manage your day-to-day operations, but
Right.
capital market sources are for longer projects. So then the only choice you have is issue debt, bonds, go for bank credit, long-term bank credit, or issue equity. If you are an established company, if people know you, then equity is better. If it's difficult, then go for bank debt. If you are, if you find the interest rate is low and people know your company, then go for debt, public debt.
Okay.
But mostly projects for more than 1 or 2 years, capital market resources, external funding, not internal funding. You may not have enough cash to fund that project. You'll have to go for external funding.
Right.
Right. Yes. Okay. Fine. So that's the end of our sources of capital.